My SIP returns is negative. I'm investing for the last 2 to 3 years, and why it is still negative or why it is still flat? How long should I keep on investing? Should I change my investment pattern or should I increase my amount or decrease my amount? Or is mutual fund the right investment choice for me? If these are the questions lingering in your mind, then this video is for you. Why your SIP returns are negative? What should you do with your portfolio or investment choices right now? This is what you're going to see. And yes, welcome. This is Ganesan, your investment expert. I will help you to choose the right investment choice for you and so that you increase your money flow in your life and you attain financial freedom. Okay, so let's begin this week's topic. So, why SIP returns are negative? And this is an interesting topic because the people who started investing during COVID and after COVID, they started seeing the negative returns, and because of that, either they are planning to quit or thinking, should I switch my fund? They understand that mutual fund is for long term. Is this the right kind of investment, or should I switch to some other mutual fund? So this is the question. So the first of all, the most important point is, did you choose your investment timeline? Because if you're choosing equity, you should have a patience of 4 to 5 years bare minimum so that you're seeing double digit returns and sometimes even beyond that 6 to 7 years so that your portfolio, your particular mutual fund is performing extraordinary, at least on par with benchmarks, say 12 to 15% in general. This is what I say to all my clients who come to me for investing in mutual fund because certain people think that in 2 years itself they can see a very good positive returns. Last week there was a discussion with one of the new client and he just wanted to get a clarification for a few questions he had us in mind. So he wanted to invest in a tax saver newly, and he thought that for the last year he invested in a particular fund, quantum tax saver fund, and this year he was asking, will I be getting the same 40% returns? And even after 3 years, will this return sustain? Because he invested for the last 1 year. From last year till now, his investment has given 40%. So he wants to understand that because taxable is for 3 years, at the end of third year, will the same 40% exist? And the new fund, whatever I'm recommending, will it stay? Will it also give the same 40% kind of stuff in the long run? And then I clarified like investment doesn't work that way, and in particular ELSS doesn't work that way, and how quantum as a fund they started growing in the last couple of years because of the aggressive churning and because the size of the total portfolio is very less compared to any big mutual fund, so they were able to give extraordinary returns in the last 3 to 5 years timeline. And slowly as a mutual asset under management of all these companies starts increasing, automatically the returns will also moderate. So this is the norm across the mutual fund houses. So then he wanted to think over and decide what should be the choice of investing. So the investment timeline, the most important point is, are you investing for your long term goals like beyond 5 years? If it is beyond 5 plus years, you don't need to worry, keep buying, because keep investing, because the more you buy at a lower level, it means that you keep on accumulating, because the most of the net asset value starts with the value of 10 rupees, and over a period of long term, say 10 to 20 years, it can go even up to 1000 or 2000 rupees, because there is a fund called Nippon India Vision Fund, where it started at 10 rupees in 1996, and this year 2023 it has crossed 2000 rupees. It is beyond 2000 rupees. It means that 26 years for sure any fund is going to perform beyond. So for your retirement, for your child education, for your child marriage, or for any other long term purpose beyond 5 plus years, for sure fund will perform. And you need to analyze the fund and invest. I'm not recommending this Nippon India Vision Fund, but this is how the fund's performance will be. You should also be comparing the same kind of funds. For example, if it is a mid cap fund, you should also compare it with a mid cap fund. Let me show you a choice how you should monitor and how you can understand all these things. Okay, so this is money control, and once you go to the mutual fund options, you can go to equity mid cap, because this is a choice, you can select anything. Just look at the year to date returns. It means that beyond for the last 4 months it has given a -1%, -3%. And just look at the 1 year returns: 5%, 10%, 6.7. Nippon India has given 6.42, whereas PGIM has given sorry, PGM is different, 2.19%. Mahindra Manulife 4.17, Kotak Emerging Equity 5.33. So by seeing this, UTI Midcap is given 1.87. By seeing this, you may understand that the fund is not performing. And this fund, Aditya Birla Sun Life Mid Cap, it has given 2.74, and there are funds like DSP Mid Cap and IDBI has given negative returns. But if you look at the long term returns, just look at 17%, 18%, 18 long term in the sense 10 years. Even in 5 years, it has given close to 11, 12% only because of the market condition. Only PJM has given 2% in the last 1 year, but in 5 years, this is the only fund which has given 15.55. Remaining funds, Motilal Oswal 14, SBI Magnum Mid Cap 12, but in the 20 years timeline, the returns are changing. Just look at 10 years, sorry, in 10 years, SBI has given 19.58%, whereas Quant has given just 15%. And Nippon India has given 17% in 10 years. In 5 years, it has just given 13.56%. So everything changes in 5 to 10 years timeline. So it purely depends upon the fund manager and how the fund is performing in the long run. It means that how they are operating and are they taking time to go through the multiple market cycle, because if there is a time period where mid cap stocks alone will perform, and during that time period are these funds going to perform, or they will take couple of multiple cycles, maybe one and two, and then they will reach a peak. So is this what the fund manager is proposing? Is this what the fund manager is watching? You should understand this viewpoint of the fund manager before deciding to invest your money in this kind of fund, because patience will be tested if this is the strategy they are following. Because Access Midcap Fund didn't perform for the last couple of years, and when we approached all the funds across the Access AUM was not performing because they follow a strict cycle that whenever the market is sideways, their fund will perform, and whenever the market is going reaching the peak, their fund may not perform better because they have a they focus towards the value oriented stocks instead of just going along with just with the market cycle. Like if it is peaking, it will peak. If it goes down, it goes down. Nothing. They have a strict strategy of value. So if the value stocks is performing, this fund will also perform. So similarly, for each and every mutual fund, there will be a strategy followed by the fund house and the fund manager, and you should understand before deciding to quit or before deciding to leave as it is. So investment timeline is one of the important point. And again, I already touched upon this point. The second most important point is invest for your financial goals. Do you want to invest for next 5 years? Do you want to invest for the next 10 years? All these are important criteria, because if it's a 5 year fund, you should choose a multi-year set or aggressive hybrid. Don't go for pure equity. And if it is 7 to 10 years time, then go for pure equity, and you can be super aggressive like going with a small cap or flexi cap, or you can moderate down to multi cap or whatever. So depending on the timeline, depending on the your financial goal, you can decide your timeline. If your timeline is retirement, you can go all out into small cap or sectoral funds, so that in the next 20 years timeline, your fund will be super aggressive, super returns will be super aggressive performance, because it needs more time. Sectoral funds and thematic funds, certain thematic stocks funds will require more time, and then only they can give huge returns. For example, IT stocks will take lots of time because in the last 2 years, because of quantitative easing coming down in US and recessionary fears rising up in US and across the world, and banking stocks going down, all these have made sure easy money is not available to the entire world for the next, at least for the next couple of years, a few years. So this had a huge impact on all the IT stocks. So Amazon, Facebook, Uber, all the companies which had risen up in the last 10 years, they started beating down because the valuation has become so high. People thought that most of the people across the world thought that these stocks cannot come down, these stocks cannot fight. So this is the point you should understand. There can never be a situation where any company cannot become immortal. For sure, they will come down. It has happened with most of the companies at every time, and this is the timeline for all these IT stocks. FANG, Facebook, Alphabet, Amazon, uh, Netflix, and Google. So all these are companies which were performing like anything, and everybody said that these stocks cannot fail. But it started coming down, and because of that, you can see the IT stocks in India was also coming down. So IT stocks in India for the last 2 years, IT index didn't perform. Let me show you that also so that you can understand much easier also. Okay, so the year to date in IT index is minus 27%. Just look at year to date for the last 1 year, it's minus 27%. It has gone down, and in 5 years, okay, it's not clear. Let's look at this 1 year return. 1 year return is minus 10%. This is the IT index. It has gone down by 10%. 2 years return is 9%. So if you had started investing in IT index related stocks the last 2 years, may be positive, and if it is less than 2 years, for sure it will be negative. 3 years, just look at 98%. It means almost your money has doubled if you had started investing for the year 3 years, and if it's 5 years, just look at still 98%. So the stock market will, if the stocks are performing, automatically the IT index will also perform. If IT index is performing, automatically your IT related mutual fund will also perform. So this is the most important point. And finally, the SIP returns depends on the IT stock index performance. Because if the SIP return, if the IT stock index, if the stock index is performing, automatically the SIP returns will also perform. So let me go back to the same view in money control so that you can. So this is related to IT, and let me show for banking stocks. So this is for banking stocks. Year to date return is 22%. Let's see for 1 year. It's 19%. So the last 1 year, if you had invested in banking related mutual fund or banking stocks, you would have seen enormous returns, particularly PSU banking stocks. So if it has been 2 years, 32%, it means it still performed a lot better. Just look at 3 years, 101%. So it means average returns if you are investing in banking stocks is cumulatively close to 20-25% returns per year. Sorry, close to 30% per year, and hence you have got 100% in 3 years timeline. So this is an opportunity to understand if if the stocks are performing or if the particular sectoral index is performing, automatically the SIP returns will also be positive. And suppose if the stocks are not performing, automatically your returns will also not perform. So let's look at the Nifty returns. Just 6.29% Nifty returns, which means any large cap stocks, large cap funds, mutual fund SIP returns will be barely single digit, 6.29%. And let's look at 2 years timeline, 24%. It means close to 12% CAGR. And let's look at 3 years. So it is from the time where market has crashed because of COVID, from that timeline to till now, March 2020 to almost March 2023. Just look at 84%, close to 20% CAGR. So if you are investing in large cap or index fund ETF focusing on large cap stocks, automatically your performance will also be superlatively high. So what this says is that your SIP performance is purely based on IT stock index, IT or banking or whatever. And if you are investing in a mid cap or a small cap or large cap or whatever, those stocks needs to perform so that your fund is performing. Suppose if your particular fund is not performing, make sure you are checking the uh, peer group. Meaning, if you are invested in UTI mid cap, check Axis mid cap, DSP mid cap, Edelweiss, Kotak Emerging Equity, so that you can understand is this the negative returns with respect to this fund alone, or is it across the fund houses? Okay, so you can understand from this viewpoint and be clear. If either you to increase your allocation or stay as it is. Let the SIP returns continue. Let me track the returns over a period of next few months to years. So if this is done, you can be rest assured that your SIP will also perform in the near future, and you can keep investing. So don't forget that if your fund is not performing, it means that you're accumulating units at lower level, and sooner or later, once the stock starts performing, your SIP returns will also become super performing. So stay tuned. If you have any questions, please post it in the comment so that I can answer those questions. Thanks a lot.